Have you ever wondered why traditional investment approaches sometimes struggle to fully capture the dynamics of certain assets? It turns out that not all investments play by the same rules, especially when we venture beyond stocks and bonds. Alternative asset characteristics significantly influence risk models by challenging the core assumptions underlying conventional financial theory. Unlike traditional assets, alternatives often exhibit unique features such as illiquidity, information asymmetry, and non-normal return distributions. These distinct attributes necessitate a fundamental adaptation of standard risk management frameworks to accurately assess and mitigate potential exposures. The primary reason for this influence stems from the breakdown of key assumptions in models like modern portfolio theory, or MPT. A foundational concept typically assumes assets are liquid, returns are normally distributed, and information is readily available. However, alternatives often lack these qualities. For instance, private equity investments have long lock-up periods, real estate transactions are infrequent, and hedge fund strategies can involve complex, opaque instruments. These characteristics lead to higher estimation risk, meaning it is more difficult to reliably forecast future returns and volatilities. To properly account for these differences, practitioners often employ specialized analytical methods. This means moving beyond simple variance and covariance measures. One practical step is to use nonparametric approaches, which do not assume a specific return distribution. Another involves liquidity-adjusted value at risk, or VAR, models that explicitly incorporate the cost and time required to exit an illiquid position. Furthermore, incorporating qualitative factors and scenario analysis becomes crucial, allowing for an understanding of how alternatives might behave under various market stresses, not just historical averages. A key insider detail to remember is the concept of fat tails in return distributions, which is particularly prevalent in alternative assets. Unlike the bell curve of normal distribution, fat tails indicate a higher probability of extreme positive or negative events. This means that while standard deviation might appear low, the risk of a significant drawdown could be much higher than conventional models would suggest, highlighting the importance of stress testing and sophisticated tail risk measures like expected shortfall. Ultimately, recognizing and adapting to the distinct characteristics of alternative assets within risk models is not merely an academic exercise. It is about building more robust and resilient portfolios. By moving beyond conventional frameworks and embracing specialized tools, investors can gain a clearer, more comprehensive understanding of their true risk exposures, leading to more informed and confident investment decisions, especially when navigating the complex landscape of alternative investments.